Okay, record. This record should be working. Thanks. Okay, 1 second. I'm taking roll. Participants. Who's that? Anna is here. Renee's here. James is here. Petrus is here. Lewis is here. James Hong. James Hong is not here. Mark LaRue is not here. I'm going to send out a email message to the class. You can watch the recorded lectures, James. In fact, there's recorded lectures now on under web links for this course. The tax planning course is also recorded. Meeting name, International Tax. Okay, so Mark is not here. Bob and Susanna. Ming is here. These for principals. Ondura is missing. Nitesh is here. Okay, pretty good. So, I'm going to go ahead and start showing my screen. So you're going to get the little a presentation will begin in a moment. I'm going to do what I did last week. I'm going to continue to use my laptop screen as the audio, and this seems to have worked best to save people bandwidth. Show my desktop. Oh, James says I'll be away midterm week. Well, I can make the midterm available earlier. It's multiple choice. I can even make it available later. I'm randomizing the questions so everybody has a different test. Okay, I'm hitting start. Now, Alan DeCoker will start lecture. I think he's on his way back to South Africa right now from Florida. I talked to him a day ago, so he'll be taking over the lectures, and so the lecture schedule is as the syllabus states. I'm going to open up the classroom right now. Just make sure we're all on the same page. In the syllabus we have, I'll give you so to make sure you see what I see, the student page. You have me through the 23rd. Then you have Professor DeCoker, Mike Rinaldi, going into Kleinfeld, Langer, and so on for the tax treaties class. So there's the syllabus to make sure we're all on the same page. Secondly, as I said, the course materials. We put the original course materials here. You should follow the link to the publisher. And then all the registered students, I'll have a list, and I'll check that list on Friday. And we'll make sure that everyone's in it. If you haven't bought the books, then we presume you're only auditing, you're not taking the midterm, or whatever. You won't get the password for the midterm. Let's say we got the overheads. I'm going to go ahead and click the overheads. We're going to be referring to the overheads in our later lectures and somewhat even today. Module 1, Text and Study Guide, I've opened up already at the bottom of my screen. We're going to start diving into that next week. Today's lecture is going to be on the context of tax treaties. On the context of tax treaties. Hold on, I see that message. I have to open my chat box very large so I can read it. Do I go to IBLS to buy material? That is correct. For this course, you go to IBLS. To clarify, because there's some new students here, every course, different publishers. So if you're in Thesis 1, you're going to Wolters Kluwer to buy teachinglaw.com. By example. And if you just ask your instructor, they'll provide you the link of where you're going. Some courses you don't need to buy materials because it's the teacher's materials, and they're not in book format. They don't have a publisher. Some courses they're just using study guides, and they're leveraging database materials that have been not for this program. They're just general materials used by anybody, like on Checkpoint or CCH or something like that. And a point that I'll make in all the classes. This is very cool stuff. We now have both the new 2 databases up and running. One is on CCH, the other is on Checkpoint. This is particularly interesting for you, Renee Caputi. There's a new CCH on the database list you're going to notice with its own password, and under Checkpoint we've included it, or it works so that it's included in the first 6 or 8 accesses on Checkpoint. This is the international tax compliance and forms compliance and rates comparison databases that both publishers have come out with and they're competing against. If you don't know what I'm talking about, there is a streamed lecture. We recorded the lecture by the Checkpoint trainer, and in October on the calendar, you'll see that CCH is providing a lecture on their product. The products take all the forms in all the different countries and translate them into English. They also have the International Tax Expert program under Checkpoint that calculates all the potential routes using treaties or no treaties, using havens or no havens, intermediary countries and companies or no intermediary countries and companies, for all the different possibilities and all the different rates. And you can type in your numbers and come out with the final after-tax number at the end of each strategy. Very cool databases for y'all's use. Okay. I'll keep making that announcement until people start using them. Yeah, from your point of view of HSBC, you should definitely be checking these things out. They're going to make your life a lot easier, especially in the private wealth management world. Wow, it'd just be so much visually better to show clients this kind of stuff. Okay. So I'm going to minimize the materials. We got our discussion forums, and we're going to stay in Module 1 for the next week, and then we'll open up Module 2 and so forth. It already exists. If I do the faculty view, you'll see that we have everything already set out. That I'm doing right now. I've clicked on faculty view, but these courses progress on a module by module basis, so this is what you see as a student. Okay. I'm now going to I've minimized my classroom. I'm sitting back in Mega Meeting. It's on your screen now too. And we're going to start with our regular lecture. So to start with the regular lecture, I'm going to first close out all the video layout and just put mine there. It's Professor Byrnes. Because I'm showing my screen from here. Yeah. Okay. Hit OK. Got it. Okay. Last week we looked at where we could find the treaties and where we could find cases associated with the treaties so that you could better engage with the materials. So when you have materials on the screen, you're able to engage through the databases connecting to the treaties. Those same skill sets are also very important for the Principles of International Tax course, the International Tax Planning course. Now, we're going to go into our proxy server so that we can pull out a treaty. And last time I showed you CCH, I showed you IBFD, I showed you Tax Analysts, and then on Thursday we ran through a few others of where to engage with the subsidiary material that fills in the missing blanks of the course materials. Again, like the case studies, like the case law. And I think we were looking at residency on Thursday, and we were using Holland as our example country, and we find those rules under the different databases in the source law. So you would be going through your proxy server and research databases, which I'm clicking open now. By the way, I forgot to answer it. Somebody said streaming lectures. The streaming lectures are certainly under web links in your course. Okay. I'm clicking on Tax International Tax. I'm going to go down to Tax Analysts because that's the one I like the best for interacting with the treaties. My personal opinion. You might prefer any of the others. That's 100% okay. They obviously all have the same treaty information in them. So I'm clicking on Tax Analysts. I'm going to go to my Worldwide Tax Treaties database, left-hand side of the screen. I'll draw a little arrow so that we're all on the same page, what we're looking at. I click on Worldwide Tax Treaties. I'm going to go straight to my model treaties. Now, I told some people outside of class, I always get this question anyway, what are the daily news sources you look at or what have you to quickly update yourself? If you're doing tax treaty work, then the best daily news service, I think, again, personal opinion, is right here with Tax Analysts. And you don't have to have a subscription. I think you can just go onto the taxanalyst.com website or taxanalyst.org website, and they have all the daily news stories, certainly the titles and a little bit about it on their page under the International Tax page. So you would, if you're a treaties person, you'd come to your tax analysts every day. If you prefer BNA, you would go to your BNA International Tax Daily, what have you. And you would get the look at, isn't that interesting? Saudi Arabia approves draft a treaty with Holland, with Netherlands. Cayman Islands, Cyprus, Save Tax Agreement published. All kind of things are happening in Cyprus, British Virgin Islands. All kind of things are happening in the tax treaty world right now, from tax information exchange agreements, savings tax agreements, and so forth. Cyprus seems to be very active, Anguilla, Aruba, and so forth. Okay, but that's not the topic of today's talk. It's contextualizing tax treaties so that we understand and we can better approach how they fit into the international financial services world, whether you're dealing with private wealth individuals or whether you're dealing with companies. So we're going to look at the model treaty, model convention. We'll use the OECD as our starting place. Now, in course materials, you're going to get, certainly what I'm talking about in class is expanding upon course materials. They overlap, although they approach it from various perspectives. The commentaries, which we briefly mentioned just as a research point last week, I put a little arrow to where the commentaries are, will help you understand articles. And what we looked at last week was that the various countries accepted to the general conclusions of the commentaries that they all unanimously agree on, but they have their own exceptions written to the commentaries based upon their domestic systems. The introduction of the OECD, and I've just clicked on these two links. I'm just waiting for them to come up on my screen. But I clicked on introduction. I clicked on introduction again. And in front of you, you should see the introduction screen in a moment. And it's going to say historical background. So everyone should read this document, which I'm highlighting now, from the historical background, that's number A, all the way down to the bottom. This will help you understand the context of treaties. Now that I've shown you this, let's take a step back and understand what treaties are all about. Okay, so why do we have tax treaties? That's the question to be asked right now. I'm going to put up our country A and country B. These are two sovereign states. They have independent jurisdiction to levy taxes and to collect those taxes. A has capital, has wealth in some form. Let's say, give me an industry. Somebody can chat an industry into the chat box, and I'll use that as the example. Anybody chat in an industry, go ahead. Educational services, okay. Oh yes, because you're IPO. But that's a good one. Okay, so let's say that we have a educational company like an Apollo Group, or DeFry, or one of the for-profit companies. So we don't get into the tax-exempt issues right now. So instead of being Apollo, we'll call it Acme. Acme Education and Training University and Company. And Acme has done very well in the domestic markets of country A. And Acme is now a publicly listed company in the domestic markets of country A. So we're building our kind of fact situation right now. So what is Acme? Acme is publicly listed. So we'll say it's public. Thus, its shareholders are going to come from many different elements. And then what we'll get to is that some of those shareholders even come from State B. And is Acme even a State A company? It might be resident and taxed in State A, but its ownership may be actually in State B. Okay, it's a public company. Right now, its income, let's call it 100 to make for easy calculation numbers, all results from student fees in A. Its income. To make that income, we'll call it its deductions just to make life easy. We'll say its deductions are 50. We're going to make Acme be a very profitable company. And its primary deductions come from paying salaries, let's say, for instructors. So we'll just simplify it, and that's their big expense in life. Not buildings, not materials, and so forth. Leaving Acme, we're forgetting tax credits and all that kind of thing for the moment. We'll say a profit of 50, an earnings and profit of 50 that they would normally, let's say the country A's tax rate is 35%. And so Acme would have to pay how much tax? What is 35% times 50? I know there's accountants in the room. 35% times 50 is? No, it's not 17,000. I don't know, 12 or something. No, more than 12. 18. 17 and a half, 18, something around 18. Yeah, okay. If it's 17.5. Okay, so we'd be left with 32.5 and remaining potential distribution or reserves to shareholders. But Acme sees the potential to train in country B. So Acme, let's say the country B is the exact same kind of socio-economic climate as country A. What does that mean? Well, if country B was Brazil, Russia, India, China, Africa, one of the African countries, and country A was America, not taking into account yesterday and today's market corrections or meltdown, whatever one, we won't know for a few weeks what's really going on. Then B has a risk factor well beyond that of country A. So I'm not talking about that kind of risk factor of an OECD country versus a non-OECD member. Some OECD members have higher risks than other ones too, of course, from political instability, government expropriation, and other factors in their economy, hyperinflation, like in Argentina. Not now, but a few years ago. Okay, so A and B are not dissimilar. However, for any company that this is for basic terminology right now, we're calling it a country A company, ACME. It's resident, and we haven't looked at resident, and all those are later on lectures. But we're just assuming that ACME is a tax resident of country A for purposes of the discussion. For any country on a risk management, and for any of you who are tax counsel inside of a company, or if you're going to be practicing advising companies, then you must automatically take into account a risk factor when dealing with another country's economy. It may be language. It's because you don't know the marketplace, and there's consumer socio-consumer behavior patterns that you have to figure out, and that costs money. There's regulatory differences. And this is forgetting the economic differences of hyperinflation or political risk and all that kind of stuff. This is just a normal, I'm going to deal in another marketplace. We even have this in the United States. If I'm a California company and I want to go deal in Louisiana, if I'm a West Coast company and I want to go deal in the South, there are differences from state regulation to slight socioeconomic differences, slight consumer preference differences, and these have to be taken into account. The reason I'm saying that is that all this risk, extra risks, risk beyond this risk factor, which is just my normal risk in country A, is heightened by some level. I call it 10%. Not significant, but there are new challenges. Okay. ACME believes that it can achieve an income in country B of tuitions once it has penetrated and gotten market support, that it can make another 100 in tuition in country B. ACME determines that its salaries are going to be a combination of people from country A, and those salaries are going to equal 25. I'm using very easy numbers. And then we have salaries from country B, instructors, and those are going to be 25, giving us the same inevitable situation of our profit of 50. Let's say that our tax rate for country B is only 30%, though. So that leaves us a slightly better off situation. 30% of 50 is 15. So that would be our tax due. That leaves 35 for distribution back to the parent company or to the head office. We haven't talked about whether it's a subsidiary or going to be a branch, what it's going to be. The 35 is not the real story yet, because we still have to take into account that the 35 has a slightly higher risk factor. So the 35, if it was true cash flow, is 35 in cash, no doubt, yet no pain, no gain, higher risk, higher reward, all these kind of management assessment tools on an operation come into play. And while at 35 is certainly worth 35 until we start getting into the how are we going to get it back home, withholding taxes and so forth, just contrasting 35 versus 32.5, the risk factor may make my 35 worth only 32.5 from a risk weighting to obtain the same amount of money. Okay, that's more MBA stuff, or value business operational side of things. Okay, so now let's start going through, now that we've set this fact pattern up, let's talk about the impact of a foreign tax system, B, relative to A. Let us say that Acme sets up a subsidiary in B. So we have Acme public company, Acme subsidiary in country B. I now have, at the end of my operation, 35 profits. How do I get my profits back to country A? Under just blasé normal circumstances, the 35 would come back as a dividend distribution. So I would have a cross-border dividend distribution back to Acme. And what normally happens on dividend distributions? Normally there's a withholding tax, a domestic withholding tax. Let's say that the withholding tax is 25%. So it's 25% of 35. 25% of 35? 8.75. So now we subtract 8.75 from, I see that, Petrus. I mean, the bandwidth looks good on my side, but I don't know why you're losing the... So we have 8.75 subtracted from 35. So what does Acme receive now? $26.25. Now, if you're taking notes, I'm going to point out some other factors and then come back to the 26.25. The other factors that we have to take into account that are important for the tax treaty are individual taxes, employment taxes. Although we're talking about Acme as a corporation, I purposely divided up the employment amounts. Under country A, we had 50 in salaries, and that's taxed under normal A, domestic income tax for employees amounts. In country B, they have their normal, just like country A, domestic income tax for employee amounts. Let's say that our country A employees, that's the blue 25, that they have to pay income tax in A, and they are subject to income tax in B. So their salaries may have to be higher, because assuming the employees aren't going to want to go work for less, especially if country B is a more expensive jurisdiction to do business in, Europe versus the United States, or country B is a higher risk jurisdiction like Brazil, Russia, where kidnappings happen frequently, especially to foreign international workers, even to instructors. That 25 is not really worth 25. So, thinking back to my just previous discussion on the risk, 10% risk assessed against, ratioed against the 35 profits before withholding, may make that 35 worth less than 35. Operational risk assessment analysis to obtain the same money I would under my domestic A system. That same analysis is taken in the context for wealth managers or for expatriate immigrant managers who are looking at tax treaties for individuals. And that, so I'm pointing out just that the same analysis we're making for Acme as a corporation, one would also make for the employees or for high net wealth individuals crossing borders or having lifestyles in different borders, having homes in different borders. The same analysis applies. Okay, I'm going to go back to my Acme analysis on the public corporation level, but I'm just pointing out that if you're an individual planner, it's the same sort of analysis. Okay. Now, I want to take my 35, bring it home to Acme in Country A. I had a withholding of 25%, and I had a withholding of 25%, and the 8.75 was withheld, paid over to Country B, leaving me 26.25%. Now, Acme has to look at the following investment aspect of a business operation in Country B. How much investment did Acme have to make to produce 32.5 in Country A? Well, I haven't told you, how much money went into the business, was capitalized, and so forth. Let's just assume, to make it easy, that the investment is just the $50 of deduction in salaries. So for $50 of deduction in salary, I produced a return of 32.5 that can be distributed to shareholders, or part can be kept in reserve for later investment, part can be distributed to shareholders. Now, on the Country B side of the business operation, I also invested 50, not taking into account that my blue 25 may have to be increased if something doesn't correct the taxation, regulatory, or other differences that may increase the 25 to get to the same investment unit amount, dollar amount, because of higher Social Security tax or double taxation or what have you. So to invest 50 in Country B has only returned me 26.25%. Again, not taking into account the risk factor of Country B. If you're the board of Acme an investment in country A pays better than an investment in country B. Now let's say that Acme could have invested the 50 in country A and produced more tuition dollars. Perhaps not 100, but 90 or 80. Now you start doing a functional analysis, an FA, a functional analysis of the risk-reward return based on investment, factoring in risk, and what inevitable potential return it will produce you. And in our current scenario, if you could invest another 50, instead of doing it in country A, you invest another 50 in country, instead of doing it in country B, if you invested another 50 in country A, then you could produce 90 tuition. So you have some diminishing return here. It leaves you 40. We have our 35% rate. So what is 35% times 40? It's less than 17.5. 14. Okay. So we're left with 26. We'd be left with 26, and I know this is oversimplified, but anyway, we're left with 26. Now, under the country B scenario, we have 26.25, except that we didn't take into account the risk. For our 26 under country A, we don't have to have our risk. We don't have the situation that our 25 below salary level is potentially going to be more, so that we're actually going to be, it's not going to be 26.25. Our return will be less in country B. Anyway, just simplifying it, taking into account the risk, our 26 in country A is an easier 26 than the 26 out of country B. So in this scenario, the board is going to choose country A. Now, there are other factors that take into account in business. Risk diversification. Maybe I want higher risk somewhere else just to diversify from having too much exposure to the markets of country A, as in the United States right now in the last day. There are other factors that become part of this dynamic process. But in our closed universe of the fact scenario I'm giving you, country A's investment appears better than country B's investment, even though they come out with very similar numbers. Back to the context of what tax treaties are doing. Now, if we look back at history for a moment, many economists put forward the idea, and probably military experts also, though I haven't read military experts at the time, but many economists and call it diplomats put forward the idea after World War II that one of the causes of World War II, besides hyperinflation in Germany, which many blame on as a result of the Versailles Treaty, the causes of World War II was a lack of economic integration. And from that discussion resulted the European Union today. so it went through its various phases to get where it is. But a lack of economic integration led to the potential for military conflict. And that if the countries had been economically integrated, that there was capital flows, investment flows, employment flows between all the countries, so that like the 50 United States, there was a almost perfect integration. The countries wouldn't go to war with each other because, by example, with China and the United States, if China's not so invested in the United States, they have a lot of bonds. The United States is heavily invested in China, in goods and services and capital equipment and so forth. And it's a mainstay of our economy, that cheap labor source. The United States and China can't possibly have a real conflict because the resulting economic damage will be large. Here's an example from the newspaper I read yesterday. Iran withdrew $70 billion from Europe this summer because of the threat of sanctions against Iran, and that their money might be seized as a result of the potential conflict because of their nuclear program. They put the $70 billion Europe into gold, and I don't know where the gold is, but I wasn't that interested in the article. I was just interested in the money movements part of the article, preparing for this course. So Iran had made $70 billion of capital investment into Europe, and then withdrew that $70 billion. It's gold maybe sitting in Dubai. If there's an integration between countries, they can't go to war because the resulting economic damage is just by the threat of conflict is large. So France and Germany cannot fight each other anymore. They'll be fighting themselves. They destroy a factory in France, but the factory is actually a German factory. So back to my story on Acme. Acme is a public company, but it may turn out that this public company is owned by various investment funds, of which the investment funds are, let's say that Acme is has 5 major owners, to simplify it again. And one major owner is pension fund for a state or region in country A. And another owner is a investment fund in country B. And another owner is a insurance company in country C. And another owner is a hedge fund, oops, it all disappeared, a hedge fund in country D. And so on. So Acme has a fragmented ownership. If country B destroys Acme in a war, it's destroying its own investments. And this is a historical reason why tax treaties and economic integration came about. They could not get economic integration without tax treaties, and that's what we're looking at right now. So in our comparison, we have Acme with 26.25, and we have, or we can produce nearly the same amount with in country A. Now, freeze that thought. I'm going to open up another window to expand this conversation so that you really understand it in the global network of capital flows. And then we're going to come back to Acme. I'm going to go to the Bank of International Settlements.
Is the stock market problems not a direct of the current?
No. The stock market problems of the immediate current moment are massive corrections occurring as a result of the overvaluation, or you can say it another way, of assets, or the undervaluation of certain risks and potential losses. And now there's a psychology in the market which is just I don't know, but that's my 2 cents. Okay, so I'm looking for the Bank of International Settlements. Who's heard of the Bank of International Settlements? What does the Bank of International Settlements do? Yeah, let's hope overcorrection. Yeah, because it's really, really, really bad for our markets what's happening right now, because AIG and Citibank's exposed for $139 billion to Lehman Brothers through bonds. That's a lot of exposure. I could not believe my eyes when I saw that yesterday. The point is all of our retirement accounts and pension funds hold shares in AIG and Citibank. Lehman's obviously doesn't exist anymore, so nothing to hold. Well, it does exist, but it's insolvent. Merrill Lynch actually got a premium from some people's point of view. From the Merrill Lynch shareholders, they seem to be suing, saying they didn't get enough. But you know, it's a pretty hectic. It seems that nobody really had information in terms of the valuation of the potential losses forthcoming, or the overvaluation of assets. Okay, Bank of International Settlements. The Bank of International Settlements is the forum where all the world's banks, world's Federal Reserves, world's central banks, and the allying banks who are members of those banks take their daily capital flows and account for them. And so let's say, and I'm going to come back to Acme, but I'm upping it a notch to the whole world. And if we were to look at the publications and statistics, and I've put it up on your screen now, about BIS statistics. The cross-border lending and borrowing of internationally active banks and key financial centers, including offshore centers. The BIS is a data collection center, but more than data, they're actually it's the actual money movements between countries, cross-border between countries, so that you can monitor the capital flows, the investment flows amongst all nations. The BIS shows how integrated some systems are. Some systems, I mean, by just countries. The United States with the region of Europe, the United States with the region of Asia, and then country by country. I can, by example, click on BIS Reporting Bank Summary of International Positions. I'm not going to go through how to read the statistics. I'm just giving you the example because I'm contextualizing the discussion of treaties. This also applies to international tax. And if we go down our stats, we'll see the external positions of banks in all currencies vis-a-vis all sectors. For individual reporting countries, these figures are in billions of US dollars. And you'll get like Cayman Islands, by example. And you can track investment and growth trends over time. Okay. Now we have our assets above, and of course, with any balance sheet, there are liabilities. So we see Caymans and we see Caymans down below. Okay. Now, you can have this country, so you can actually go country by country, though, with the other statistics and see how much money from Singapore to the United States or vice versa with the Bank of International Settlements. The reason I'm showing you these stats right now is that you can, on your own, I've used these stats many times to determine capital flows. Like, if you ask me the question, did the tax savings directive impact Europe, and if it did, where did the money go? Well, all I would do is look at the European countries and look historically at their investment flows from, and use a regressive analysis. I would look at France, or savings directive, not France. I'd look at Isle of Man or Switzerland or Luxembourg, and I would look at where their money has traditionally been invested over time. And then let's just say that I found a blip from like an extra $20 billion going from Luxembourg to Singapore. Well, I would then have to look at what other factors could have caused that blip. By example, maybe Singapore was doing huge infrastructure projects from the government, and so therefore there's more money flowing into those infrastructure projects. If I go through all these potential anomalies and find out that there aren't any, well then I might have a correlation between the tax savings directive and the money moving from Luxembourg to Singapore, by example. So you can use these statistics to follow transfers. Okay, I'm going to close out Bank of International Settlements and go back to ACME. So historically, the economists and the diplomats believe that cross-border integration is a good thing and that it keeps us from having wars. Libertarians, free market capitalists, Adam Smith kinds, like myself, I believe that trade is a good thing because it makes everybody better off in the world. And that the more restrictions or regulations or costs, administrative costs, as Petrus referred to them, put on trade, the more dampening effect, mitigation of the benefits of trade for countries. Now, with ACME, I'll rewrite my little stats on the board. ACME had 50 profits. It had a 30% tax rate in country B. What was that number? 15. So it left it 35 to distribute. 35 was my distribution. Back to country A. That's and it's being recorded, James. I had a withholding tax of 25%. Under these circumstances of A to B, Acme would not invest in B. They would stay at home. To encourage integration, to encourage the reduction Okay, so the bilateral investment treaties alleviate the risk of expropriation. So that alleviates some of the political risk, and it also alleviates the risk of countries treating foreign investors, so that would be B, treating A's company, Acme, differently than it treats its own investors. Now, the second type is the DTA, Double Tax Agreement. Some people call them DTC, Double Tax Convention. Or TT, Tax Treaty. I usually use DTA, Double Tax Agreement. So this is not a course on BITs, but we did discuss BITs in the International Tax Planning course in summer. BITs are also discussed in the Immigration and Estate Planning course because they allow treaty investor visas. So country A and country B have come together for a DTA negotiation, and they have to discuss a fair, call it tax levying between the two of them upon the investments of Acme, i.e. the investments of a country from one country, a company from one country to a company in the other country. For treaty terminology, there's certain buzzwords for people who speak treaty talk, and things like winner country and loser country, W country and L country. So we're going to be referring to those terms as we go through our treaty relationships and discussion. We're still under the topic context of tax treaties. So A and B come together under a tax treaty, and they have to agree about certain investments, capital flows between the two countries. So what were our capital flows for Acme, our education company? So Acme, our education company, had to invest some money in terms of labor, was our simple circumstance. We had a 50 profit, we also had a 50 labor. And that was 25 units of labor based on the expertise of Acme Country A employees coming over, and let's say that was to train the 25 units of labor necessary of Country B's people. So there was an investment of technical skills and know-how by the Country A 25. They had to come from Country A, and they earned personal income. There's the dividend flow. And if Acme is going to be expected to invest in Country B, it needs to be able to withdraw its investment profits back to its home country, and not be in a worse off situation, or be in not a significantly worse off situation than it would if it was investing back home. Otherwise, you have this situation we saw with, I can invest 100, I can invest 50 in Acme Country A and still come out with 90 or 80 and still be better off from a risk factor. So A and B have to agree how they're going to treat dividends, how they're going to treat personal employment income. If Acme needed to build a building for a university, how they're going to treat immovable property. If Acme was investing into, was going to purchase a subsidiary. So Acme didn't invest in a subsidiary in Country B by setting up a new one. It bought an education company in Country B. And it buys that for dollars, the shares of that company. And so it'll have a potential capital gain in the future should it sell that company. And so on. So if we look at our treaty, let me pop open the treaty screen. And I'll go to my model treaty. The articles, I'll make all this disappear from your screen. What we note from the structure of the model treaty is the types of income that A and B are going to discuss. Now, I haven't given you the context of why the OECD model exists versus the UN model versus the US model versus another thing out there. And there are other models, regional models. But in the context of tax treaties as a whole, so what types of income do we discuss? We have income from immovable property, Article 6. We talk about business profits, Article 7. Shipping, air transport income. We have dividends, interest, royalties, which includes rents, leasing, and so forth, Article 12 income. We have Article 13 capital gains. We have our personal services, independent and income from employment, dependent personal services, Article 14 to 15. We have directors' fees, and so on down the list. Then we get to our exemption and credit methods. So from the treaty's structural aspects, the first part in Joel is dealing with definitions. The second part is dealing with the types of income, and that's the levying or the collection of tax types of income. And the third part is dealing with relieving double taxation. I'm just giving a general perspective. Entry into force does not, relieve double taxation. Termination is not relieving double taxation. I'm just giving a general overview. We're going to spend the next 2 weeks looking at Part 1, persons covered, taxes covered, general definitions, so forth, onward to permanent establishments. On permanent establishments, Alan de Coker will take over. Modules 1 through 6 are addressing Articles 1 through 4. But in doing that, they use examples of Part 2 of this treaty, the Structural Elements 2, Articles 6 through 22, talking about the types of income and the taxation of those types. And then at the end of the course, but more so in principles of international taxation, we'll get into exemption credit methods, tax credits, and so forth. Marshall Lenger will be talking a lot about exchange of information, assistance in the collection of taxes. That's Articles 26 and 27. Okay. Now, the countries have agreed that it is a good thing to have cross-border investment to integrate their economies. I'm not going to do why the OECD came into existence today, but you can certainly read that on the OECD website. So I would go in and that's going to be one of your assignments in Thesis 1 if you're in that class. Reading about the OECD. So I would type in www.oecd.org if I'm not sure what the OECD is. And then if I want to understand more about the OECD treaty, well, I can certainly read it under the history of the treaty as we saw with tax analysts at the beginning of this lecture. But I can also go into the by topic, look for taxation. I see that under finance, by example. And then I can go look at the and then I can go look at the treaty and the information about the treaty published on the OECD website. Okay. So the two countries, A and B, let's just take an example of how it works in practice. The withholding of tax on the dividend from country A to country B, and we'll do that by looking at Article 10 of this OECD model. Again, noting that we haven't discussed what's the difference between the OECD model, the UN model, and so forth. Okay, Article 10 on your screen. The two countries have come together, and let's say that they have agreed this article as the article for their tax treaty between A and B. And the article reads, dividends paid by a company which is resident of a contracting state, paid by a company. So this would be Acme's subsidiary. So we're going to call that Acme, which is resident of B, Acme subsidiary, resident in B, to a resident of the other contracting state, this is to Acme, the parent, which is a public company, and the other contracting state is B, may be taxed. May be taxed. Okay. So how much may it be taxed? So in our Acme situation, we had 50 minus 15, so we had 35 dividend for distribution. 35 dividend that can go from B to A. And B requires that Acme subsidiary withhold 25% of the 35 dividend and pay that over to B's government. So paragraph 2 says, however, such dividends may also be taxed in the contracting state of which the company paying the dividends is resident. So that's the company paying is the subsidiary, our Acme subsidiary. According to the laws of the state. Well, the laws of the state say 25%. And then it says, but the tax so charged shall not exceed Internet is not good. I assume everyone else can hear me right now, so I'm going to keep finishing this, but I'll finish it up in 5 minutes. Yeah, okay. So the tax, but the beneficial owner of the dividends is a resident of the other contracting state, blah, 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 blah. The tax so charged. So this directly, and we'll go through how you interpret all this in our later lectures. This is just our example to see how it works in practice, how they negotiate, and how this rate affects our investments. Shall not exceed. So this 25% is normal under the domestic laws. So according to the domestic laws, 25% is okay, but then it says shall not exceed. And then we have two choices, A and B. So our 25% is now limited to either 5% or 15%. So country B may only collect 5% or 15%, and it's going to be depending on whether this is a portfolio investment or whether it's not. And the portfolio investment is going to be, that term's not used, but the portfolio investment is going to be defined as holds at least 25% of the capital. If Acme parent holds at least 25% of the shares of the capital of Acme subsidiary, it's not a portfolio investment. But if Acme parent owns less than 25% of the subsidiary, then it's considered a portfolio investment and taxed at 15%. In our example, we'll say that Acme owns 100% of the underlying subsidiary. Thus, the 25% replaced with a maximum collection amount of 5%. And we're not going to go through the whole the rest of this article, But now the two countries, having agreed this article to be in their tax treaty between themselves, so the 35 that is distributed by Acme subsidiary of country B no longer has a 25% withholding. It has merely a 5% withholding. So the withholding on the 35 is now reduced to what's half of 3.5? 1.7 something. Yeah, 1.75. So so now we've had a tremendous amount of savings of over 7 units, and the investment of Acme in country B is much more palatable. We still have not talked about, does country A now levy income tax on the amount of money received from Acme subsidiary of country B? Because if country A, upon receipt of the 35 minus 1.75, so the 33.25, if now country A levies 35% tax, country A's tax rate, well, that leaves the final figure at like 22 or 21, 20, something like that. Well, that's a much less return on expenditure, return on investment than Acme gets from investing in country A. So that has to be examined, and that's where tax credits come into play. Some countries deal with it differently, and they exempt the dividend from tax in their system. Like internally in the United States, we have the dividend deduction, which works as an exemption system internally. We also had a reduced corporate tax rate on dividends from overseas. George Bush did that. He reduced the corporate tax rate on dividends received from certain overseas companies. And that changed 3 times. They had one rate, then they had another special rate, then they went back to the first special rate. And under the new administration, that'll change again. So the two countries, A and B, come together and they discuss, going back to my OECD slide, or OECD treaty, they discuss model conventions. Convention. Okay, so they discuss Article 2 dividends. They discuss Article 23 or B, A or B exemption or credit method. They discuss the business income. They discuss the personal income tax to be levied on that 25 salaries we mentioned in our example. And the objective is to at least ensure that the investment that Acme has made in country B at least that as an investor, Acme is treated in the same circumstance as if Acme was a country B company. That's called non-discriminating. So it's not treated as a foreign company, a country A company. It's treated as a country B company. It's not discriminated against. It may get more favorable treatment. It may be positively discriminated in favor of, but it won't be discriminated against. It won't be less favorable treatment. Some countries encourage investment through treating foreign investment as better than their own investment. That's fine, James. We're going to wrap it up now. And number two, saying non-discrimination. And number two, that the inevitable taxes suffered by Acme are not a result of double taxation. And double taxation is not so obvious. We'll have to be looking at that closely in lectures, because some lecturers just describe it as if it's as if everyone understands what it means, but it is not so simple. And even the word tax is not so simple, and we'll be looking at the word tax in our international tax planning course, even on Thursday. Okay, I'm going to wrap up this lecture now. Everyone needs to read the history. So I didn't go through the history of the OECD because you're going to read that. I've given that as an assignment. You have your lecture materials themselves. You have the reading materials, the study guide, which is on your screen now. I'm going to close that. And the text materials and interpretation tax treaties. You have the model convention, but what you're supposed to look at again is the history of it. Okay, I'm going to stop showing my screen. Are there any questions of me helping to contextualize why the treaty is in place? Okay. In the classroom, by the way, as I reminded you already once, under external links, we have 2 lectures under external links that you're required to watch. One is recorded from last Tuesday, and the second one is an IRS lecture, which is necessary for next week. The IRS lecture. It's the IRS lecture on tax treaties. Internal Revenue Service U.S. lecturing on its negotiation for tax treaties, as well as the application of tax treaties to avoid double taxation. So with that,